Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, where I continue my conversation with Karsten Schroeder, co-founder and executive chairman of Amplitude Capital. Obviously there are more of the medium to long-term trend following managers out there.
Yes.
And so it's quite interesting to hear sort of your perspective. And that is, the debate, I guess, very often comes down to, are people using moving averages or are they using price breakout as their indicators? What's the pros and what's the cons? But actually, my question is more, does these traditional trend following type indicators, do they also have validity in the short-term space?
I don't think that anything that you can read in a book as you read it there will work in the short-term trading space.
Okay. Now, if I understood you correct, essentially your models will build you based on the signals, will build you an optimal position. So is that to take it that you essentially are kind of scaling in and out of markets? You're not sort of, in and then suddenly you're out. It is more of a process because the models work together to give you the desired position. Is that correctly understood?
That's correct. I mean, we obviously have all sorts of models that work together, and then we have kind of like a net situation between all of their inputs, and that will give us the ultimate positioning in the markets.
Sure. And when you, if we just look at it from sort of a model by model point of view, does each model have any kind of stop loss when it gets engaged, or is that really? And I know we'll talk about risk management in a little while, but just out of curiosity, when you decide on the size of the position for a particular model, does that go in any case in alignment with some level of stop loss for that, or is that handled differently?
Well, stop losses. The meaning of stop losses in short-term trading is not as big as the meaning of stop losses in longer-term trading, because your models are relatively short-term and reactive. So it's once you have them, it's not as meaningful. Sure.
And when you look at models, is there anything that you look for in terms of contribution, meaning that, a model, in order to make it into the portfolio, has to produce, more or less the same contribution over time? I know they won't do it month by month, but over time you're looking for a certain, profit contribution for it to make it into the portfolio in the first place.
Well, it depends on the situation. We're mostly talking about components here. So components have to deliver ideally a consistent improvement in the system, or if they are introduced for a particular reason, then they have to deliver that specific performance characteristics. So I don't think that you can make a general statement towards that extent that somebody has to do an X% of performance contribution. It's like what we do has a lot of component building, and so when we look at a new component, it just really has to improve what we have currently, and if it does that, then that would lead to potential implementation.
Sure. And in this sort of the short-term space, if I can refer it back to the medium to long term trend following strategies, just to have a reference point, a lot can be said that actually the entries and the exits are not that significant. And what is really significant is actually how you size the position. How does that sit in the short term space? Because I could imagine that entries and exits also play maybe a bigger role due to the slippage factor that you've alluded to a few times. But I imagine that still position sizing also plays an important role. How do you see that?
Well, nobody wants to do trades like big trades on one go. So everybody tries to split up those trades. Entry and exit points are a design question of your program. That's a general efficiency question. Like, entry points will define your reactivity. So a short-term trader will obviously enter a trade earlier on than a longer-term guy. And then the question is where you exit it. So you can exit it obviously through other models or through like the reversion of your indicator actually turning around. And whatever your models will tell you, obviously nobody wants to like do big trades in one go. So in designing your models and designing your execution strategies, you always want to have smaller activity at any given point in time.
Sure. And staying on that subject of sort of trade implementation, I imagine that your systems essentially are running 24 hours a day, 5 days a week, and just constantly looking for these opportunities.
Absolutely. We are trading all markets. We are trading Europe, we are trading America, we're trading Asia. So yes, we are running 5 days a week, 24 hours a day.
Sure. And how long does it actually take from a signal to be generated for it to be executed? I mean, how are we? Because obviously, again, in the longer term space, it's not that important. But how quickly do your systems have to react to these things?
Well, because we are still operating on a directional basis here, and we're not doing any arbitrage things, I don't think that like milliseconds matter so much to us. So it's not like we have to say, we need to be co-located to like do our business. But you got to be fast. So of course we have a solid infrastructure, and we choose counterparties that have a robust infrastructure, and we have dedicated connections. So you would not obviously go through an internet connection for that.
Sure. And just this is not related directly to Amplitude, but just you know a lot more about this than I do. And there is a lot of talk at the moment about high frequency trading, and the politicians and other groups of interest trying to maybe restrict that to some extent. Is that kind of definition of high frequency, is that sort of so to speak, much shorter term than what you actually do?
Yeah, I mean, that is significantly shorter term, and it has a different functionality. To be honest, it is more an issue on cash equity trading, in particular when you have markets with defragmented liquidity. Let's say defragmented markets, so where there's not all the liquidity on one big central exchange, so you have dark pools. And there are various exchanges. Those are things that we do not favor, and any regulation that tries to mitigate this, we're clearly in favor for, as well as any regulation that would address message to fill ratios and co-location, because it's I think markets are not there to create a technology a technology game, and at the end it's about investments, and it's about placing assets, and not doing like tech war games. So therefore, anything that creates a stable, solid marketplace, we are clearly in favor for. And I don't think that like all this co-location stuff and market order book manipulation is really helpful. So message to fill ratios, when they become unhealthy, I think it's absolutely reasonable to introduce penalties there.
Sure. And now, at 1.7 billion under management, clearly execution is a major focus. Do you see, with all the computer help we have nowadays, are you still able to find new efficient ways of executing your trades, or do you also have to rely on certain increased liquidity, generally speaking, in the markets in order to, do you think, achieve the goals of, say, 4 or 5 billion under management?
I have to say, from a pure slippage perspective, the last couple of years actually have not been that bad.
Okay.
So it's either, some markets from a liquidity perspective have been somewhat constant, and with the way we design the programs and the way we've implemented execution strategies, we've managed to continuously lower our execution cost.
Okay.
So whilst assets were rising, when 2009 or 8, we had like 800 million. Now we have 1.6, 1.7 billion. That's obviously, I think that's a good result from a way how we managed to digest this additional asset load.
Absolutely. Now, I want to change subject away from trade implementation and talk about risk management. I'd love to hear if you could describe in your own words how you define the risk and how you set the framework of sort of your risk levels or targets in broad terms, and how you embed it into your programs.
Well, the way the portfolio is constructed, as alluded to earlier, is very much driven by volatility and liquidity in the markets. At the end of the day, the risk you have is like the position you have in the market. The bigger the position is, the bigger your risk. So being a short-term trader, obviously risk management plays a bit of a different role because your models are so reactive. So you will have, if the market turns the other way, you will turn the other way pretty quickly as well. Of course, there's the risk of overnight and over weekend gaps, which you will be exposed to, and there's nothing you can do about it.
Sure.
And we do have position limiters and risk limits, in particular, how big aggregated positions can be. Mm-hmm. And we also have 2 risk management layers that will filter volatility developments and decrease the position sizing accordingly.
Sure. And does market correlation play a different role when you're short term than it might do for sort of more the traditional trade length of a medium term or long term manager? I
would say market correlation plays a smaller role the shorter term you go. Yeah, because then, you treat the markets individually, you react individually. But I can totally see that. Obviously, if you're a long-term trend follower and you're flat out long in all equity markets and you're flat out short in all bond markets, that's a position. Of course, sure. If things go the other way, then you're going to be very exposed, and it may take some time to turn around. So from that perspective, I would certainly manage that. Yeah, absolutely.
Sure. Now, shifting gear again to another topic that people like to talk about, drawdowns. A big part of being a CTA means that you're in a drawdown of some sort. And what's happened in the last few years, not necessarily in your case, but certainly generally in the CTA space, is that the drawdown profile has changed in some cases quite dramatically compared to maybe the previous 2 or even 3 decades. What have you seen in terms of your own drawdown profile in the last few years? If I'm not mistaken, actually, you're not that far away from an all-time high, but yes. But you may have seen something during the last few years that you can reflect on.
So drawdowns are, everyday business in the CTA, because statistically speaking, I think you're only at 20% of the time you're actually in a high water.
Sure.
And it's a natural thing with a trading strategy. Now we explain environments to our clients, like what would lead to a drawdown. We are not a big fan of drawdown management because it statistically doesn't make sense, in particular for a short-term trader, because the position you have on tomorrow is independent from the position you have
Sure.
today.
Sure.
So if you cut it while you're cutting it because you lose conviction in the program, well, then you may just well redeem, because when you cut in a drawdown, you lock in the loss and you will limit yourself in the recovery.
Sure.
And nobody can tell you a priori how big a drawdown is going to be. there are statistics that you can say, well, a drawdown should not be bigger than 1.5 times the volatility. Well, given the wrong market environment, it can be bigger.
Sure.
Do drawdowns have changed? I don't think so, really. I don't think that the environment we're currently experiencing is like creating tail risks for CTAs. It's just like a bit of a mediocre, shitty environment, which just doesn't allow you to make a lot of money. I don't think it creates a huge problem. It's just like, it's not that there are extraordinary bad price movements. It's just like they're not the great runs where you can make a lot of money on.
Sure.
It's more that problem.
Sure.
Then there are obviously strategies that were relying on certain value or that are relying on trades or exposures which have changed, which will experience a drawdown, because so far those trades have been very beneficial for a very long period of time. But even then, since this is all being communicated and should have been understood by the investors, I don't think that you can blame it on the funds.
Sure.
That comes back to almost comes back to like when you do a credit trade and you're trading a spread, then, well, yes, you collect premium as long as that spread works. If things go bad and you have a highly leveraged position, well, then you have a problem. You can't really complain about it because you should have known it all the time. I mean, that's why you're collecting a premium.
Sure.
Because there's some sort of tail out there. So to that extent, I think when you understand what a strategy is doing, you kind of can relate to the drawdowns, but never forget, there's no guarantee in terms of a maximum drawdown.
Absolutely. I'm sort of just taking what you've said earlier on and trying to put it together here. And it would seem to me that because you have or you want to play a specific role in the portfolio with the downside protection, would it be a fair statement to say that typically maybe your drawdowns would then occur when other things in the portfolio of an institution, the bonds, the stocks, whatever it might be, are doing well? So in a sense, the timing of drawdown may actually be less stressful for the investors in your case, because they may occur at a time where other parts of the overall portfolio is doing well.
Yeah, absolutely. I mean, a drawdown occurs in our case when you have range-bound markets. So, I mean, the very perfect example is like what we've seen now in May with equities just trading range-bound in a 1.5-2% range. So that's obviously not helpful, and that should not be a stressful period for investors, generally speaking.
Sure. But I'd like to hear your comment on this question due to your experience. But of course, drawdowns for many investors and for some managers certainly add to the emotional roller coaster. How do you balance this emotion when the drawdown periods occur?
Yeah, I mean, I can totally agree. It is a bit of an emotional roller coaster, and even if you don't, when you add up all the negative days you have in a year and you add up all the positive days,
sure,
then the delta would be like obviously the return you make. I mean, neglecting geometrical effects here, but the number is actually surprisingly big in terms of the negative and the positive performance that you will have to digest. So
sure.
My point is, when you're percent up for the day, you go like, yeah, I mean, that's kind of like the way it's supposed to be, right? But so your positive emotions towards that 1% up are not as strong positively as your negative emotions when you're percent down.
Sure.
Or even, let's say we take the spread. Let's assume you're 90 basis points down and you're percent up. If you continue to do that, you're going to have like a, kind of like a somewhat good scenario here, or let's say 80 basis points down, 1% up. So that emotionally would still feel tough because you're doing a lot of 80 basis points.
Sure.
And I can agree. And also with fee, negotiations, putting pressure obviously on management fee, is you'll become more and more reliant on performance fee, and that's the gray side and the dark side of the business.
Sure. Is there anything that managers can do to help investors overcome these concerns where, you know, they don't necessarily have to see a drawdown as a big risk, but just part of the strategy? I mean, I guess you are doing a lot of that, you know, being so intimate with your investors in your dialogue. But I mean, is there anything in general you think we or managers can do a better job of explaining this?
Yeah, I mean, first of all, I think at least in our case, I feel like the emotional stress is higher on our side than on the investor side, because, I mean, the investor has a portfolio. I would say, generally speaking, the portfolio would have done relatively well in the last couple of years. So,
sure.
whilst we only have what we have. But coming back to your question, I think that it's, well, there are two things. I mean, you should be transparent, you should be honest, and you should be humble. And that those three things in combination actually will get you a satisfied investor.
Sure. Next area that I'd like to talk about is really research. We've already, or you so elegantly said that, you know, investors, they want managers to continue to innovate and evolve, but they don't want change. So I know that's certainly, you know, as, you know, part of the setting, but in terms of research, do you have like a cycle of research that you follow, or how does research come about? Is it ideas being thrown around in the office, or how does that work? Because I know that's a really big part of what you do and a big part of your success.
Yeah, I mean, research is the integral part of the business, and at the end of the day, when you invest, you are not getting the track record that has been there. You will get whatever we will manage to produce in the future. So research is certainly, from an investor's perspective, the topic that you should spend most of your time on due diligencing. Not really so much like maybe the actual things, but like how the process works. And because you have to be comfortable with the process, because at the end of the day, the manager is not going to turn to you and say like, oh yeah, we have this idea, do you think we should implement it? So you have to be comfortable with the way how ideas are selected, how they are managed, and what the decision-making process towards an implementation or a rejection of that idea is. And so we have a committee which manages this. I'm managing the research with my co-heads. We have weekly research meetings where we discuss on an open forum what's going on, so that also sometimes helps to get ideas from other team members. Basically, projects get allocated to individual research members who will do the testings, who will get ideas, who will try to work that problem. And then as things, you know, may look good, we do a lot of validation work. So validation means, like, first of all, that the all the programming has been done correctly, that we understand all the impacts in terms of where the performance has been coming from and what negative aspects of particular components there potentially could be. And as all of these questions get answered along the line, it may eventually lead to an IT implementation.
Sure.
And there's a sign-off process, actually. There's a system that we have internally which is like requires a couple of people to say, yeah, this is actually okay, and nobody has any major concerns before things will actually being put in place.
Sure. And do you feel that you might be a little bit constrained in your research, given the fact that you, on one hand, you want to have a certain profile of the product, meaning, you want it to make money, when equities go down. So I could imagine that excludes some ideas because they may not be, working in that kind of environment. So do you feel that there are some constraints as such, or not really, as long as you, know what you're looking for?
Well, there are sometimes situations where you have things that may look attractive, but that just don't go along with what you're doing or what you're supposed to do. And then it's tough luck. I mean, then you just have to stick with, like, what your kind of mandate is. And otherwise, there's always room for creating new programs or creating prop testing stuff and looking at things. And we're currently building an equity strategy, and we've been building it for quite some time. It's now in the prop trading phase. So there's always that that opportunity. I think when you do things when you want to do things that are not within your original return characteristics, you should carve it out.
Sure.
If you think it's awesome, then carve it out, make a new program. You can make it available to your investors either as a component or even as a new program. I think that's totally fair. What's not fair is just changing stuff on the back of like not really telling people or forcing them into something that they maybe don't want. And to be honest, I mean, look, we have a product here that has a very high liquidity. If you start doing this, you run the risk of your investors saying goodbye because they're just not comfortable with style drift and strategy drift. Yeah.
Sure. No, I can completely agree. Now, shifting to another area, which is a little bit related to what you just said, the business side. Now, overall, I would say Amplitude has been the exception to the rule in the last few years. As you've described, you've had an amazing growth at a time where a lot of managers have had decreasing asset bases and some have even gone out of business. Why do you think you've been so successful?
It comes back to a point we were talking about early on, is like the selection of your investors. We actually, sometimes people may take this the wrong way, that they say, oh yeah, like the guys from Amplitude are arrogant, or we have no interest whatsoever in hot money. So the moment when you start a conversation, the first question from the other side is, can we see the performance from last year? That's kind of like a showstopper. Sure. There's no issue with looking at performance. Don't get me wrong. I mean, at the end of the day, we are getting paid to make money for investors. But if that is your primary concern, then we are probably not the right fund for you. So having clients that are really interested in what you do and like how you do it and when it makes money and when it doesn't make money, that's kind of like the client you want, because that is also the client that will stay with you through more difficult time periods. And I would say our growth has never been aggressive, apart from maybe 2007, 2008, where, by the way, we had hot money flowing in, which did flow out in 2009, which we replaced with institutional money. We're not going to make the same mistake again. Yeah. So ever since, we had a pretty slow and steady growth with no real negative years on AUM. So I think to that extent, it's been stable. It's not been a radical growth path, but it's been stable. And I guess that's also thanks to a very good communication we have with our client base, and Heiko is doing a really good job in keeping everybody up to speed there. We have regular calls on strategy. We do an on-site visit at our at our clients' offices once a year. They mostly do an on-site visit once a year at our offices, so that beyond the conversations we have on the phone or video conferences, there's also, seeing each other and talking about things in a bit more detail. And I guess that's important.
Sure. Communication is certainly key. And speaking about offices, I wanted to ask you something completely different, and that is location freedom, because you've actually also done something a little bit unique. Namely, you chose to move away from the pulse of one of Europe's financial centers to the a little bit less stressful place of Zug in late 2008, I think it was. Tell me about whether that's has had any impact, good or bad, on the way you do things.
Yeah, we back in 2008, we said, like, we don't want to be in a big city anymore and want to move to a place where there's a bit more of a balanced lifestyle, which from a business perspective, I have to say had no negative impacts. I mean, of course, you can move to a Caribbean island, which probably will create some issues. And also within Europe, I guess there are places which are not so, how can I say, they may not be seen from an investor's perspective as such a professional base. But I guess when you talk about Switzerland and when you talk about Pfäffikon or Zug, there's a lot of financial institutions sitting here, actually a lot of firms that are significantly bigger than we are. So also logistically speaking, it is fairly easy to get here. So we had no issues with investors whatsoever when we made that change. And from a personal perspective, coming back to the comments you made earlier on with regard to the emotional side of it is obvious. I think it's easier to handle that in an environment like we're here. And I'm just actually looking at the lake now and then seeing, you know, a kite surfer out there and just contemplating the idea if I should go in the evening for a quick run on the lake, just a quick kite surfing session. And I certainly couldn't do that in London, right? It's not an option. And we have a lot of people who have families here, who do lots of sports. And for those people, it's a really good setup here.
Sure, absolutely. Now, if we look at the CTA part of the overall hedge fund universe, when it all began, it was quite US dominated as an industry. But in the last 10 years or so, it would seem that the European managers have taken over and created some of these massive success stories, of which, you're certainly one. Why do you think that European managers have kind of become the preferred type of firm for investors to do business with?
I think that the European firms had more of a scientific approach towards it and more of a technology-driven approach towards it than the American firms. The US firms largely came from a trading background, and with the way the markets have developed, and a lot of the old firms, a lot of the old systematic firms, the old CTAs are from the US. Like the newer firms, I mean, even a firm like Winton is not that old. They've all been set up here in Europe with a strong academic focus, and that just has been really essential in the last couple of years. I mean, having said that, there are peers in the US, I think, who do really, really well, also on the technology side and on the research side, and having a lot of academics on board. I mean, at the end of the day, Renaissance technology has just like set the ultimate example. So
sure.
But in terms of vast majority, I would say, yeah, the business is currently stronger in Europe.
Sure. The last section I want to move to, I call it general and fun, but what it really is, it's about getting into hearing your sort of more personal thoughts on certain topics, and also get to know sides of you that people may not know. But I wanted to start out by asking, just generally from your perspective, what does it take to become a great trader or a great CTA in your opinion?
I think you have to, first of all, you have to love the markets. You have to love math as well, I think. You have to be good with numbers. You just have to love the idea of like trading stuff. That I think is kind of like a prerequisite. Then the question is like, what does it take to become an entrepreneur? There's like a whole range of other factors. So you can be a fantastic trader. It doesn't mean you will be a fantastic or successful hedge fund owner. Because
that's a very good point,
because there's a business side to it, and there's an entrepreneurial side and the risk-taking side to it. So there are people who are excellent traders who should actually stay in a framework where everything else is provided to them, and they just have to worry about the trading. And there are people who may actually not even be the best traders and may not even be the smartest guys and not the best researchers, but they have the entrepreneurial spirit and everything that has to come with that. And they will probably run the businesses.
Sure. And if you go back to your own beginning, were there any CTA firms that you were aspiring to at the time? Anyone that you thought, wow, if we could be like them one day, that would be fantastic?
Honestly, not at all, because like when we came to London, I didn't even know the term CTA. And I don't think I could have named anybody that would have been one of my peers. So I have great respect for the vast majority of my colleagues. I'm good friends with the vast majority of my colleagues, I would say, and I hope they would say the same thing about me. And there are firms that I think have great success. They have been built up in an amazing way. They have fantastic teams. They have great research. They have good academic people and a good process, and those are the things that we want to do. and that we aspire to, and that we try to set up and run our business this way. So I would not say that there's like a particular firm where we say, oh, we look up to them, but there are certainly really good companies out there that have done a great job, and I have a lot of respect for them. And we try to obviously continue and survive and grow the business in a steady pace.
Sure. Now, you mentioned the entrepreneurial side, and as we both know, the entrepreneurial journey is ups and downs and successes and failures. What would you say has been the biggest failure that you've encountered on your journey, and what did you learn from it?
Yeah, on the business side, there are so many things that you can do better with hindsight. And it is therefore relatively hard to pick out a failure. And that's why I would like to refrain actually from doing so, also for another reason, because I don't think that we should fool ourselves by thinking that the things went right because we made the right decision. I do really believe that the element of luck in terms of building a great business is not to be underestimated. And by luck, there's like all sorts of things. When you run a business, you have to make a lot of decisions under uncertainty. So because you're doing this, you just cannot claim that because it went the right way, you can say, yeah, of course I've known it. No, if you would have known it, there wouldn't even be the need for a big decision. It would have been so obvious. So you have to do things with a lot of uncertainty around you. And see, coming back to statistics, just because 10 times you've made really the right core decisions just does not mean that you are like, that this is the holy grail, right? I mean, you can be lucky 10 times. 10 times statistically means nothing. Like coming to an investor cycle, if you invest in businesses and you have invested in 4 businesses and 3 of them made you a fortune, are you an awesome investor? I don't think so. Because like if somebody does 100 investments and 65 are profitable and overall it's a good return, I would say you probably understand what you're doing.
Sure.
So that's why, coming back to the own thing, do I have super big regrets? Not really, because, well, you decide things the way you do with given the information, given your moral standards, given like what you want to achieve. And even if it goes wrong, I don't think that regret should really spoil your life. And at the end of the day, what you really have to learn when you run businesses, I think, once you've taken a decision, you have taken it, you took it, you stand by it, and this is it, and you put it behind you. Because I think going back and saying, oh, if I would have done it differently, I could be here and here, I think that's really a showstopper. That's going to kill you.
Sure.
Yeah, so you really got to leave it behind you. If there is a lesson to be learned, important, learn that lesson. Otherwise, that's it. Yeah. Get on with it.
Yeah. Now, you've obviously had a tremendous amount of success. So what inspires you today? What keeps you motivated to keep going?
Yeah, I mean, we've been running this now for 10 years, which I have to say feels like a long time. And it helps every once in a while just to go and like see other people. And I've just, like 2 weeks ago, I went to an entrepreneurial like meeting or get together from my university, and I have to say it really inspired me a lot, because there were like young people who had just graduated, building up new businesses, and they were super excited about it, just the way they talked about it, just the way they presented themselves. And I think you have to really maintain that attitude and that mindset. You definitely want to make sure that you stay entrepreneurial and do not become a manager. I think that's important, in particular in businesses that require a certain level of creativity. Once you lose that touch, I think it becomes an issue. Sure.
Now, I've only got a couple of questions left for you, Karsten, and this one might be a little bit, probably not tricky for you, but if you could ask a question to the next guest here on Top Traders Unplugged, which most likely will be one of your peers, maybe not in the short-term space, but what would you ask them?
I would. Well, that really depends on like what type of fund it is.
Sure.
If it would be a CTA, what would I ask them? See, it's interesting. If it would be a long-term CTA, I would really ask them, like, do you think you can continue? And by that I mean like the asset classes you've been trading, the way you have been trading them.
Sure.
For the next 5 years or 10 years, and being comfortable to say that you will make the same amount of money, or like you will achieve the similar Sharpe that you've realized in the last 10 years.
Mm-hmm. Okay. And do you know what you would ask someone in your own sort of space?
What would I ask in my own space?
You don't have to. If you don't have a question, that's fine. I actually have an extra question I just thought of, and that is, you've been obviously in many due diligence meetings, phone calls. What is the question that investors are not asking you that you think they should be asking you?
I think they should spend significantly more time in understanding when the money was made and how it was made, because investors will naturally ask a lot about the difficult periods, right, and they almost take the good periods as granted. Okay. But it is really equally important to talk about the good periods as well. Not because we want to promote ourselves. It's actually quite the contrary. To like understand, why are you making so much money in that month? I mean, is there like a downside to what you're doing there? And when would that downside kick in? Sure. Because of course we go through all the risks and all the negative months saying, okay, whipsawing here and there and so on and so forth. But sometimes you're going to ask yourself, why is this manager putting out a 10% month when the average return in the CTA space was only 1% of flat? There must be a reason for it. Like, why do you think that you've captured this? And what are you doing there? Whilst everybody else did not seem to be doing that. And most importantly to that question is, what's the downside? That is really, I think, where investors should put a little bit more focus on.
Sure. Now, final question, Karsten, but it might not be an easy one, but could you tell me a fun fact about yourself that people don't usually know about you?
A fun factor?
A fun fact. Something that people don't usually know about you.
I can tell you a fun factor. I can really imitate the Saxonian German accent very well, which of course I would never do in client meetings. It also is also not that funny in English. I could kind of like do it, but sure. I was always thinking if like one day I should do it on CNBC, but I'm kind of concerned that maybe the producers may not find it so entertaining, and it would be my final show, but it can be hilarious.
You are always welcome to come back here and do it, and we will certainly make it publicly available.
Thank you so much.
Yeah, but anyways, before we finish the conversation, perhaps you could tell me where the listeners could best reach out to you and learn more about Amplitude Capital.
So it's very easy. You can go to our website, www.ampcap.com. That's ampcap.com. And you will find a phone number and an email address. And the emails will be read by one of our assistants and then forwarded to Heiko or even to myself, depending on what's regarding. Or just call the main line in the office and then somebody will help you out.
Excellent. Well, thank you so much, Karsten. It has been great conversation. I really appreciate your transparency and your willingness to share the insights and views that you have on your own strategy and your firm and the industry as a whole. And of course, our listeners can find details on our discussion today in the show notes for this episode on toptradersunplugged.com. And I hope we can connect at a later date and hear about all the great thing you do and maybe even a new product being launched.
Thank you so much, Niels.
Thank you. Take care.
Take care. Bye-bye.
Bye.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.